Now, what happens to global markets when the computers just can't cope? Flash crash is the term used to describe sheer meltdowns which sometimes last just a moment. But on May 6 this year, ultra-fast automated trading resulted in the Dow Jones Index plunging 600 points in just a few minutes. And that type of trading now accounts for 60% of the US equity market and nearly a third of the trades on the London stock market. The Securities and Exchange Commission are expected to publish the results of their investigations into the Dow Jones flash crash shortly. And here, the Treasury is examining whether high-frequency trading could damage the economy. Matt Prodger reports.
At 3 p.m, May the 6th, and without warning, America's Dow Jones went into meltdown. In 10 minutes, it lost 10% of its value. Shares in giants like Apple, Procter & Gamble tumbled as $900 billion worth were dumped, not by humans, but by computers.
It's like Terminator. Machines taking over.
So shocking, the president himself moved to reassure investors the markets were safe.
I want to speak to the unusual market activity that took place yesterday on Wall Street. The regulatory authorities are evaluating this closely with a concern for protecting investors and preventing this from happening again.
But since then, there have been further smaller flash crashes in markets across the globe. Again, the suspicion on a mountain of computer-driven trades feeding off one another, their decisions prompted by complex investment programs or algorithms. It's called high-frequency trading, and it's changed the face of trading, or removed the face completely. Of course, the days when trading was all about swapping bits of paper here at the Royal Exchange have long gone. Today's trading is all about speed. It's about getting into a trade before your competitor as quickly as possible. The computers that do it can make a single trade in 16 microseconds. That's 1.5 million trades in the time I've been standing here talking to you. Each trade may make just a fraction of a penny in profits before it's sold on, sometimes in a matter of seconds. When, what, how much to buy and sell, it's all pre-programmed.
Someone will have programmed the algorithm. The algorithm will take in all sorts of information like news feeds, time series data, stock prices, what people are searching on Google, for example, and that will go into some algorithm which will decide when to buy, when to sell, and quantities.
And are they accurate?
Accurate? Well, it's very difficult to forecast the financial markets, but they seem to be very profitable.
The economist John Maynard Keynes once warned that markets can remain irrational for longer than you or I could remain solvent. The rationale behind May's flash crash came in the form of news reports of rioting Greeks. But just why the market lost control of its senses so badly, still no one seems to know. A report from the American regulator, the SEC, is due within days, but it's not expected to pinpoint the cause. The London Stock Exchange says around a third of its 500,000 daily trades are down to high-frequency trading. On the New York Stock Exchange, it accounts for around 2/3 of them. Defenders of flash trading say, in the mantra of the city, that it boosts liquidity. In other words, makes trading easier. And so what if there's an occasional slip?
This crash happened very, very quickly. It started at around 2:45 US time, and within a couple of minutes, the Dow Jones had lost 600 points. That's the second largest intraday crash in history, within 2 minutes. Within 20 minutes, it had pretty much recovered. So yes, did people lose money? People lost and made fortunes on that day. But you and I, our ISAs, our mutual funds, our unit trusts, our pensions, didn't miss a blink. Yes, temporarily your wealth and mine will have dipped, but it bounced straight back up again.
Indeed, some say the flash crash of May 2010 could have been the much more serious crash of 1987, were it not for the correcting effects of computerised trading.
What some people argue is that actually the computers were responsible for bringing the stock market back relatively quickly.
Whereas correcting the mistake?
Absolutely. Whereas in October 1987, because we were relying on the ordinary investor somewhat more, who was rather shell-shocked by the stock market crash at that point, they stayed out of the market, and the economic consequences of that were much more damaging.
What is undeniable is that markets have become more volatile, jittery, big trades swinging them back and forth. Even those who design the algorithms say high-frequency trading embodies a culture of short-termism.
The classic example would be you speak to some high-frequency trader and you mention the ticker symbol of some stock and say, can you tell me about this company? In the old days, they say, oh yes, this company, it's such and such, they do this, that and the other, they've got so many employees, they've got such and such a turnover. Now you ask this of the high-frequency people and they won't even know what the company is.
They're just dealing in numbers.
Exactly.
Matt Prodger. Well, I'm joined now from New York by Gillian Tett of the Financial Times and by Irene Aldridge, author of High Frequency Trading, a practical guide to algorithmic strategies and trading systems. Gillian